Welcome, CMA students. If you're staring down dense auditing theory and wondering how to translate it into high-yield exam points, well, you're in the exact right place. In this explainer, we're taking the textbook and turning it into highly testable, manageable chunks. We're going to break down a pretty major trifecta for the exam: internal checks, the auditor's liability, and internal audit. Grab your mental highlighters because we are zeroing in on exactly what you need to know.
Okay, here's our roadmap for today. First, we'll look at the perks of internal checks. Second, the auditor's liability. And third, defining internal audit. Let's get right into it.
Section 1. Perks of internal checks, also known as the win-win scenario.
When we break down the advantages of a good internal check system, it really falls into two distinct buckets: advantages to the auditors and advantages to the client. This is exactly how you want to structure your answer if a descriptive question comes up. For the auditor, it's all about workflow, specifically saving time and cost by using a test-checking approach rather than exhaustively verifying every single record. For the client, it's all about tangible operational wins.
Now, what's really fascinating here is the contrast between those two perspectives. For the auditor, getting that time back means they can dedicate more energy to appraising the truly critical areas, stuff like the valuation of closing stock, complex assets and liabilities, or figuring out if provisions are actually reasonable. It literally improves the overall quality of their audit work. And for the client, their huge win is that final accounts are prepared promptly at year-end, without a massive disruptive bottleneck. Let's zoom in on the client side for a second, because examiners absolutely love these points. There are 4 key advantages to remember. First, a solid system inherently reduces the chances of errors and frauds. Second, and this is huge, because work is distributed based on specific employee skills, the whole process just runs so smoothly. Third, it builds moral pressure. When employees know someone else is automatically checking their work right down the line, they tend to remain reasonably honest. And finally, as we just mentioned, prompt final accounts. It's basically a domino effect of good governance.
Section 2. The auditor's liability. The complication.
So reliance on those incredibly helpful internal checks actually introduces a pretty dangerous trap. It brings up a direct question that examiners love to throw at you to test your conceptual clarity. Does relying on an internal check system actually reduce the statutory auditor's liability? Just think about that for a second. If a company has a great system, are you legally off the hook if a massive fraud is hiding in the data you didn't check?
The answer is a resounding no. In fact, reliance actually increases the auditor's risk. Why? Because even the most amazingly sound internal check system in the world cannot guarantee the complete elimination of all errors and frauds. Collusion is always a risk. So, if an auditor relies on the system and performs test checking instead of detailed checking, they cannot escape responsibility if an error or fraud slips through undetected. The liability absolutely does not disappear just because you save some time.
To really lock this down for the exam, you need to remember a famous piece of case law. It formally established that if the auditor relies on the internal check system and performs test checking, he cannot escape his responsibility. This was definitively held in the case of McBride Limited versus Rook and Thomas, Canada, 1941. Dropping that specific 1941 case into your exam answer proves to the examiner that you fully understand the strict reality here. Test checking in no way reduces statutory liability.
Section 3. Defining internal audit. The bigger picture.
All right, shifting gears a bit. Traditionally, internal audit was viewed pretty narrowly, mostly as just a continuous evaluation of financial operations within an organizational framework, basically checking the math. But today, the modern view recognizes it as an independent appraisal of various operating activities across the entire entity. It's not just about the numbers anymore, it's about evaluating the real-world operations behind those numbers.
To give you a concrete example of this modern approach, let's look at a standard purchase transaction. The old way might just verify that a purchase was recorded in the books, but today's internal auditor asks 4 key things. 1. Was there a valid purchase requisition? 2. Was the order placed with a vendor actually on the approved list? 3. Were the terms reasonable? And 4. Were the goods duly received and physically put into stock? It's a full end-to-end operational check.
Let's look at how the ICII's Committee of Internal Audit officially defines this. They call it an independent management function, which involves a continuous and critical appraisal of the functioning of an entity. But right here is the crucial part, with a view to suggesting improvements thereto and add value to and strengthen overall governance mechanism. Notice that massive shift?
The auditor isn't just finding mistakes. They are actively suggesting improvements and adding value to the governance, risk management, and internal control systems.
And if we cross-reference that with Standard on Auditing 610, which covers using the work of internal auditors, the wording is perfectly aligned. SA 610 defines it as a function that performs assurance and consulting activities designed to evaluate and improve the entity's governance, risk management, and internal control process. There's that consulting angle again, acting as a true advisor to management.
So whether you're looking at the ICI definition or SA 610, it all boils down to three core pillars of modern internal audit: governance, risk management, and the internal control process. You'll want to make these three pillars your ultimate mental checklist for the exam. Whenever a question asks about the modern scope or objective of an internal audit, just remember that it's a continuous appraisal specifically designed to evaluate and improve those three exact areas.
Which brings us to a final, pretty provocative thought for this explainer. If test checking leaves the statutory auditor fully liable, but internal audits holistically appraise the entire operation from governance to risks to controls, who really holds the ultimate key to a perfectly governed entity? Is it the external watchdog taking on the legal liability, the internal consultant providing the broad operational view, or the management team that actually has to implement all this advice? It's definitely something to ponder as you review how these auditing systems all connect.
Consider this your ultimate cheat sheet for mastering the internal audit function. We're cutting out all the fluff today and laser focusing on exactly what you need to know and remember to completely crush this section on your exam. Let's just jump right in.
We've got a clear roadmap today based on our source material. First, we'll hit the scope and objectives of internal audit. Second, we'll look at its core advantages. And third, applicability in India.
Starting things off with Section 1, Scope and Objectives. Okay, so before we get into all the legal thresholds, we have to ask ourselves, what exactly is an internal audit function trying to achieve within a company? The text lays out 6 core objectives. To make this super easy to recall on exam day, let's group them into 3 buckets: financial, operational, and strategic. For financial and operational, you're monitoring internal controls, examining financial and operating info, and reviewing those day-to-day operating activities. Then, in the compliance bucket, it's all about ensuring the company is actually following laws, regulations, and management policies. And finally, the strategic bucket. This covers risk management and governance, basically evaluating significant risk exposures and assessing the ethics, values, and accountability of the entire organization. Now, there is a very specific distinction the text makes here, and trust me, examiners love to test this. It's the contrast between the financial and non-financial scope. On the financial side, the internal auditor is doing detailed testing of transactions and balances. They're looking at exactly how financial info is measured and reported. But on the non-financial side, it's much broader. They are reviewing the economy, efficiency, and effectiveness of operating activities. Just remember those 3 E's: economy, efficiency, and effectiveness. Internal audit isn't just about checking the math, it's about making sure the business is actually running smartly.
Moving right along to Section 2, the advantages of internal audit.
Why does management actually care about doing this? Why is it a value add and not just some mandatory regulatory headache? Well, the text gives us 6 distinct advantages. It offers direct assistance to management so they can execute plans efficiently. But pay close attention to points 2 and 3, the detection and prevention of errors and frauds. Historically, audits were just about catching fraud after the fact. But a modern internal audit, because it relies on continuous evaluation, it shifts the focus to proactively preventing those issues from happening in the first place. It also identifies weaknesses to reduce wastage, safeguards assets, and ultimately drives increased overall efficiency. You've got to think of the internal auditor as a strategic partner, not just a corporate cop.
And that brings us to Section 3, Applicability in India, specifically the Section 138 rules.
This is where Section 138 of the Companies Act steps in to dictate exactly which companies are legally forced to appoint an internal auditor. For listed companies, it's simple. They always require one, no matter what their financials look like. The real complexity kicks in with unlisted public companies and private companies. Unlisted public companies have 4 potential triggers: capital, turnover, loans, and deposits. Private companies, on the other hand, only have 2 triggers: turnover and loans. Let's break down these exact numbers so they stick in your head for the exam.
First up, 50 crore rupees. Now, this applies strictly to unlisted public companies. If their paid-up share capital hits 50 crore rupees or more during the preceding financial year, boom, they must appoint an internal auditor. But for private companies, you can ignore this. The capital rules simply doesn't apply to them.
Next threshold is 100 crore.
This one is for outstanding loans or borrowings from banks or public financial institutions. And here's the trap you need to watch out for. It's triggered if the loans exceed 100 crore at any point in time during the preceding financial year. Not just at the year-end balance sheet date, but at any single moment. And this rule applies to both unlisted public and private companies.
Moving on to 200 crore. This is the big turnover threshold. If a company's turnover is 200 crore rupees or more during the preceding financial year, an internal audit is absolutely mandatory. Just like the loan threshold we just talked about, this massive 200 crore rule applies equally to both unlisted public and private companies.
Finally, the smallest number in the bunch, 25 crore. This is the limit for outstanding deposits at any point in time during the preceding financial year. And just like the paid-up capital rule, this 25 crore deposit rule is exclusively for unlisted public companies.
So once a company hits one of those legal thresholds, who actually gets the gig? According to the rules, the internal auditor has to be either a chartered accountant, a cost accountant, or such other professional as decided by the board. But here's a huge detail that is incredibly easy to miss on a multiple-choice question. The internal auditor can absolutely be an employee of the company. That's totally fine as long as the audit committee or board finalizes their scope, functioning, periodicity, and methodology.
Let's test this out. Let's apply those thresholds with a quick scenario pulled directly from the concepts in the text. Imagine ABC Private Limited. During the last financial year, their turnover was 198 crore. They had 0 outstanding loans or borrowings exceeding 100 crore at any time. So, do they legally need to appoint an internal auditor under Section 138?
The answer is a solid no. Because they are a private company, we are only looking at 2 metrics, turnover and loans. Their turnover of 198 crore falls just shy of that 200 crore threshold, and their loans are well under the 100 crore limit, so they avoid the mandatory requirement entirely.
But let's tweak this case study a bit. What if we change their corporate structure? What if ABC was not a private limited company, but an unlisted public company with the exact same financial stats, 98 crore turnover, no massive loans? Does the answer suddenly change?
Actually, the answer is still no, at least based purely on those 2 metrics. Since the turnover and loan thresholds weren't met, the audit isn't automatically triggered. But wait, because they're an unlisted public company now, the exam question wouldn't be over. We would now also have to check their paid-up capital and deposits. If their paid-up capital was 50 crore or more, or their deposits hit 25 crore, then they would be caught by Section 138. Do you see how crucial it is to know exactly which rules apply to which class of company?
We've covered some serious ground today, from the core objectives of the audit function to the very strict legal thresholds of Section 138. If you master this material, you are going to be in fantastic shape for your exam. But I want to leave you with one final thought. Beyond just memorizing this to pass the test, think about the real-world application. How does a flawlessly executed internal audit transform a company's basic regulatory compliance into a massive competitive advantage? When you stop viewing internal audit as a legal burden and start seeing it as a strategic engine for efficiency and risk management, the true value of the CMA profession becomes crystal clear.
Picture this. You're sitting in the exam hall. The clock is totally ticking down, and you are staring at this exact question. During the 2022-23 financial year, ABC Private Limited has a paid-up share capital of 52 crore rupees and a turnover of 198 crore rupees. The company didn't have outstanding loans or borrowings from banks or public financial institutions exceeding 100 crore rupees at any point during that year. So, does this company need an internal auditor under the Companies Act 2013? And wait, what if we just flipped it to an unlisted public company instead? Well, these are the actual facts of Solved Case Study 2 from your syllabus. It is a classic, absolute textbook trap set by examiners to test your precise knowledge of legal thresholds.
Welcome to this explainer. I am incredibly pumped to have you here, because today we're going to crack these highly testable concepts together. We are diving deep into the intricate rules of internal audit in India. Specifically, we'll be breaking down Section 138 of the Companies Act 2013 and pairing it right up with Standard on Auditing 610. By the time we wrap this up, you're going to have a crystal clear, structured understanding of exactly when a company needs an internal auditor and how statutory auditors actually rely on them in the real world.
Okay, let's get into it. Here's our roadmap for the explainer. First, the exam scenario. Second, the private company rule. Third, the unlisted public twist. Fourth, the auditor interplay under SA 16. Fifth, the evaluation checklist. And finally, the golden rule of liability.
All right, Section 1, the exam scenario. Let's see exactly what we're dealing with.
Notice how carefully the examiner has chosen these exact numbers? Whenever you get a case study like this, you've got to mentally extract the core data points first. For ABC Private Limited, we've got a paid-up share capital of 52 crore rupees. We have a turnover of 198 crore rupees. And we have outstanding loans or borrowings strictly under 100 crore rupees at all times during the 22-23 financial year. Lock these metrics into your brain, because we are about to apply the law directly to them.
Moving right along to Section 2, the private company rule.
For a private company, the law is, well, it's actually quite straightforward. You really only have to check two main conditions. The first trigger is turnover. According to Section 138, a private company must appoint an internal auditor if its turnover is 200 crore rupees or more during the preceding financial year. I mean, that is a massive number. It signifies a volume of business that simply mandates having internal checks and balances in place.
Now, if they don't hit that turnover mark, there's a second threshold. A private company also has to appoint an internal auditor if its outstanding loans or borrowings from banks or public financial institutions exceed 100 crore rupees at literally any point of time during the preceding financial year. Notice the super precise language there, exceeding 100 crore rupees or more at any point of time. So even if they paid the loan down to zero by year end, if it spiked over 100 crore rupees mid-year, wow, the rule triggers.
So, what does this all mean for our case? Let's put the pieces together. Their turnover is 198 crore rupees. That is agonizingly close to 200 crore rupees, but you know what? In the eyes of the law, close doesn't count. It does not exceed the limit. Furthermore, their outstanding loans never exceeded 100 crore rupees. Therefore, our definitive conclusion here is that ABC Private Limited is not required to appoint an internal auditor. They officially escaped the mandate.
Okay, part 3. And this is where it gets really juicy, the unlisted public company twist.
Examiners love to set traps by changing just one tiny word in the prompt. What if ABC was an unlisted public company? This brilliantly illustrates the difference in regulatory scrutiny. See, unlisted public companies have public money at stake, even if they aren't trading on a stock exchange. So the Companies Act casts a much wider net. While private companies only worry about turnover and loans, unlisted public companies have those exact same rules plus 2 additional triggers. They also have to check if their outstanding deposits are 25 crore or more, and they have to look at their paid-up share capital.
And here is the exact number that catches so many students totally off guard. For an unlisted public company, if the paid-up share capital is 50 crore rupees or more during the preceding financial year, an internal auditor is absolutely mandatory.
Let's bring back our case study facts. Remember that very first metric we pulled out? ABC's paid-up share capital is 52 crore rupees. When it was a private company, we just completely ignored that fact because paid-up capital isn't a threshold for private companies. But the moment the examiner flips the company type to an unlisted public company, that 52 crore capital suddenly triggers a requirement, even though the turnover is still sitting below 200 crore rupees. The result? An internal auditor is required for sure. And that, my friends, is how you perfectly navigate and solve a multi-layered case study. Let's zoom out a bit. Section 4. The auditor interplay under SA 610. So once a company actually has an internal auditor, how does that impact the external, statutory auditor? This brings us to a critical auditing standard, SA 610, titled Using the Work of Internal Auditor. The core premise here is all about efficiency. The statutory auditor doesn't always have to reinvent the wheel and duplicate every single piece of work if the company already has a robust internal audit team. SA 610 allows the external auditor to rely on the internal auditor's work, but, and this is a massive but, only after a rigorous, proper evaluation. They can't just blindly trust the internal reports. Which brings us nicely to Section 5, the evaluation checklist.
You absolutely need to memorize this 6-point checklist for your theory questions. Think of it as the ultimate background check. First, are they an outside agency or an internal department? An outside agency might just have a bit more independence. Second, what is the scope of their work? And more importantly, does management actually take action on their reports? Third, what are the experience and qualifications of the internal team? Fourth, do they comply technically with the standards? Fifth, what's their authority level? Like, who do they report to? If they report to the CFO whose work they're auditing, that's a huge red flag. And finally, was professional care taken in conducting the audit?
Only if the external auditor is completely satisfied with all these criteria can they decide to rely on the internal work.
Now, even if they pass that background check and the external auditor gives the green light, they still can't just take a nap. There is a strict protocol. Step 1. They have to discuss their plans to use direct assistance with the internal auditor. Step 2, they must carefully read the internal audit reports to actually understand the findings. Step 3, they must perform sufficient audit procedures on a sample of the internal auditor's work to verify its adequacy. Basically, you have to test the tester. And step 4, they must inform management and get strict written agreements. Management has to agree not to intervene, and the internal auditors must agree to keep specific matters confidential. It's a highly formalized relationship.
Finally, Section 6. The golden rule of liability.
This is arguably the most frequent true or false trap you'll face on the exam regarding SA 610. Listen carefully to this exact phrasing from your study materials. His reliance on the work of the internal auditor can in no way reduce his responsibility. Let that sink in for a second. The statutory auditor is wholly 100% responsible for their final audit opinion. No exceptions.
The ultimate burden falls entirely on the statutory auditor. Using SA 610 is just an efficiency tool. It is definitely not a get-out-of-jail-free card. If an external auditor relies on an internal auditor's work and there's a material misstatement in the accounts that remains undetected because of that reliance, the external auditor is held fully responsible for all resulting damages. They literally cannot go to a court of law and plead, "But hey, the internal auditor said it was fine." The law offers absolutely zero relief for that excuse. Which leaves us with this final, vital thought. If an internal auditor misses a massive, company-destroying fraud, and the statutory auditor relied on their work without catching it, who ultimately takes the fall? You know the answer now. It is always the statutory auditor. Keep that golden rule of liability, those specific turnover and capital thresholds, and that 6-point evaluation checklist fresh in your mind, and you will absolutely crush these questions on your CMA exam. Thanks so much for joining me for this explainer, and happy studying.